Good afternoon. Valuation, is it all smoke and mirrors? That's the question. Hopefully, at the end of this presentation, we'll shed some light on this issue. I spend my life, I'm a CPA, I specialize in valuation, and it's a fairly complicated process. Often you look at the screen and you're fairly overwhelmed. There's a lot of analysis, a lot of things that you have to do, take into account. I just want to throw out an example. About 2 months ago, an investment bank issued a price estimate for Snapchat at $28 a share. The next day, they issued a comment saying that they had a $5 billion error. They understated the tax charge and profits were going to be $5 billion less, but the price target of $28 stayed the same, which is actually amazing. They reduced their profits by $5 billion, but they never changed the value, underlying value. Well, what can result in having such a large drop in earnings and the value doesn't change? Well, there's a lot of things that go into the valuation process. There's a lot of what we call noise, a lot of different variables, a lot of things moving around. But at the end of the day, you want to take all of these different things and put it into a neat, cohesive puzzle. What happened? Valuation is essentially, I'll give you the secret. There's 3 variables that every value depends on 3 variables: cash flow, risk, and growth. You don't need to know anything else. Every value is based on those 3 variables. So how did the investment bank manage to get the price target back to where it was before after making a $5 billion error? Well, all they did is they changed the discount rate. They said, well, suddenly it's a miracle. The weighted average cost of capital is no longer 10%. It's actually 8%. And that offset the $5 billion error. The price stayed the same, but there are a lot of issues, and we all know that you can take different variables and you can tweak them a little and end up at the same place. And here you had a very reputable investment bank that made an error, but hid that error by tweaking one assumption. Look at the companies that you see up on the screen. These were all companies, what I call the old paradigm, things that were really valuable a couple years ago. I remember there was a Blockbuster on every corner. Now, most of those Blockbusters in my neighborhood anyway are urgent care centers. If you look at the new paradigm, companies like Tesla, Uber, Airbnb, Carvana, these are all the new paradigm companies with very little earnings, but are valued, have these huge valuations. What makes all these companies valuable? Well, the new buzzword out there is disruptive technology. These companies theoretically all are doing something disruptive, and this makes them highly valuable. Look at Airbnb, currently valued at approximately $31 billion, has no tangible assets, made its first profit in 2016, but it's valued at more than Hilton Hotels, Wyndham Hotels, Hyatt Hotels, and valued almost as much as Marriott. But remember, this is the combined Marriott after they merged with Starwood. Before the merger, Airbnb had a valuation that was higher than every publicly traded hotel company. Smoke and mirrors? I don't know. Look at Uber. Uber's currently valued at $66 billion, which is amazing because no one's ever had access to their books and records. They've never made a profit, but they command this huge valuation. Tesla's another company out there that sells much fewer cars than Ford and GM, much less profitable, lower revenue, but because it's perceived as being disruptive, it trades at this huge multiple. Its equity capitalization is more than Ford, more than GM, but its revenues and its profit and the number of vehicles that it's selling are significantly less. Again, the question, smoke and mirrors. If you look at this is what we call the value continuum. As companies move up that continuum from startup to stabilization, they're supposed to become, they get more valuable. Well, have some of these companies jumped up a few steps in this value continuum? And it's all a question of perception. Are we undersimplifying these issues? Is the glass half full or half empty? And I end this presentation with one comment. This week was 20 years since Amazon went public. When Amazon went public, they called it Amazon.com. Well, if we invested $10,000 at the IPO, that $10,000 would be worth $5 million. And if I had made the investment, I know I probably wouldn't be standing here today. And so 20 years ago, would we have said smoke and mirrors? I don't know. Thank you.